Analysts frequently model global food supply chains as standard manufacturing sectors. This approach assumes that inputs, processing, and distribution follow predictable paths that can be managed through historical probability. This dashboard illustrates the tools of that perspective: linear growth projections and likelihood impact matrices. These models assume market movements return to a stable historical average. But the model fails when a localized weather event destroys a harvest while a major importing country's currency depreciates. Variables overlap, and the projected path fractures into chaotic trajectories. These shattered projections reveal a deeper reality. Agri-food systems operate under physical and biological constraints that do not exist in manufacturing. The very first limit is the biological cycle. While a factory can add a third shift to increase output overnight, an agricultural producer is bound by planting windows and herd gestation. Supply remains rigid, even when price signals demand expansion. The second major limit is strict perishability. Fresh food has a narrow window for handling. A minor logistical delay, or a cold chain failure, destroys the economic value of the output entirely. The third limit is inelastic aggregate demand. Humans have a baseline caloric requirement that cannot be delayed. This ensures constant pressure on the system, even when prices spikes or incomes fall. When these factors interact, a small upstream supply shock, like a localized drought, creates massive disruptions. Because the supply is rigid and the demand is persistent, the impact becomes nonlinear and spreads across the macroeconomy. To survive these conditions, analysts must replace linear forecasting with dynamic scenario planning and substitute average cost accounting with marginal analysis. Applying standard commercial optimization to biological systems results in invisible, catastrophic fragility rather than true efficiency. Strategic failure often begins with a specific analytical error, treating risk and uncertainty as interchangeable concepts. In strict economic terms, risk describes outcomes with known, historically backed probabilities. This bell curve shows a predictable range of seasonal yield fluctuations. Routine equipment failures, seasonal weather patterns, and standard shipping delays fall into this category. The variance is measurable and bounded. Because these risks are quantifiable, organizations can use mathematical models to optimize their exposure and financial tools to insure against losses. Uncertainty involves structural shifts, where the likelihood of an event is unknown. It arises from interacting shocks that lack a stable historical precedent. A geopolitical conflict blocking a vital shipping route during a spike in fertilizer costs represents a structural break, making it impossible to assign a reliable probability to the outcome. Standard optimization models fail in these environments because the foundational data used to calibrate them has become unstable. Managing uncertainty requires building physical architecture for resilience, specifically through redundancy and liquidity, rather than relying on spreadsheet optimization. At the microeconomic level, failure often stems from a reliance on average total costs when making short-term decisions. Consider a food processing plant with idle capacity that receives an unexpected export order. The ledger shows an offered price that falls below the plant's average total cost. Under standard accounting, the system rejects the order. This rejection is an analytical mistake. The average cost includes fixed overhead and past capital expenditures that will be incurred whether the order is accepted or not. These are sunk costs. They represent past financial commitments that should not determine current, short-term opportunity assessments. A more effective framework uses relevant costs and marginal analysis. We look only at the additional cash required to fulfill this specific increment of production. If the offered price exceeds marginal variable cost, the order generates a positive contribution. Accepting it adds to total margin. In volatile markets with perishable goods, waiting for a price that covers historical average costs often leads to idle capacity and the total loss of the product. Rational resource allocation depends on separating the accounting records of the past from the marginal opportunities of the future. Agri-food systems face rigid physical constraints. Resources like water, labor, and cold storage are strictly finite. Opportunity cost measures the value of the best alternative sacrificed when a resource is committed to a specific use. Here, the choice is between 100% utilization and holding a 20% buffer. Standard metrics encourage utilizing every available resource unit to maximize immediate output. A sudden environmental shock, like a heat wave, reveals the danger of that optimization. The left crop fails with no backup. The right system uses its buffer to survive. Maximizing the asset on the left carried a hidden opportunity cost, the total destruction of the organization's emergency buffer capacity. This principle applies throughout the chain. A warehouse filled to absolute capacity cannot accept diverted inventory during a logistics crisis. High utilization may look like efficiency in a report, but it acts as a fragility multiplier in the real world. Market dynamics are rarely perfectly competitive. The structure of the chain determines who absorbs costs and who captures margins during a shock. This hourglass structure represents monopsony power. Thousands of fragmented farmers funnel their output into a tight bottleneck of a few large processors and retailers. Upstream, thousands of individual producers compete intensely against one another. Because their products are uniform, they have almost no pricing power. The bottleneck is controlled by concentrated actors managing data, brands, and distribution access to millions. When a global shock hits, like a fertilizer price spike, a cost wave starts at the bottom. The bottleneck prevents that cost from passing to the final consumer. Concentrated downstream actors protect their own margins by refusing to increase the prices they pay to their suppliers. This forces extreme margin compression onto the fragmented producers, who lack the bargaining leverage to negotiate. Understanding food inflation requires looking past aggregate data to see how structural concentration dictates the distribution of losses during a crisis. Moving from diagnosis to action requires a shift towards scenario planning. Scenario planning maps operational responses to plausible structural breaks rather than attempting to predict specific outcomes. A mature strategy ignores broad probabilities and focuses on specific threshold triggers. A threshold trigger is a predefined rule. If inventory cover drops below a specific level, the organization immediately activates a secondary, higher-cost supplier. These decisions are based on marginal economics. Action is taken based on the cost of the next move, free from attachment to sunk costs. Eliminating single points of failure requires an explicit investment in redundancy. Diversified sourcing and reserve liquidity carry carrying costs that efficient models try to avoid. The organizations that survive the next decade will be those that accept these costs as necessary investments. In volatile agri-food markets, the supply chain that appears most efficient on paper is frequently the most fragile in practice. Long-term viability depends on deliberately trading theoretical peak efficiency for calculated resilience and strategic optionality.